Quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, Corporate Treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode. Welcome to the Corporate Treasury 101 podcast. This is the third and final part of our full interview with Matheus Zani, where we discuss non-deliverable forwards, NDFs, in financial risk management. In the episode of today, expect to learn what is an NDF and how does it function, what are the potential pitfalls or challenges when using NDFs, what issues can arise when using them, beyond NDFs, what other hedging instruments are popular in the Latin America region, whether there are specific strategies businesses employ to manage and reduce these costs, and like always, much more. Latin America is a fascinating region, and especially when it comes to FX risk management. And we got to talk to a very expert of the region, so we truly hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. We are now on YouTube, and you can get to listen to our episodes whilst actually watching us. So if you could support the show, head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help more people learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. And with all that being said, please welcome Matheus Zani. Awesome.
You mentioned earlier a term, NDF. Could you explain NDFs? Like, what are NDFs and how do they work?
No, for sure. NDF stands for Non-Deliverable Forwards, which are derivative contracts designed for hedging currencies in markets with limited convertibility. They operate as agreements between two parts, typically a company and a financial institution, your counterpart. So you exchange the difference between the agreed upon forward exchange rate and the prevailing spot rate at maturity. So pretty much is that you exchange the rates. And also another feature is that NDFs don't involve physical delivery of the underlying currencies. So this is the main feature. So it makes NDFs ideal for managing exposure to non-comfortable or restricted currencies. It's a big advantage.
Okay, so that would mean if I contract an NDF with you, Matheus, for 100 million Chilean sol, at maturity, the value of the sol would have been 120 million. You will only transfer me 20 million. Basically, that's what it means. You will not send me the whole contract. You're just sending me the difference, correct?
Yes, correct. It's only the difference. In the settlement, you have the P&L, the profit and loss. So you'll be receiving the profit or paying the losses to the institutional counterpart. But it's exactly as you said, it's just the difference between the for the rate against the rates at the maturity.
Super interesting. And so why is that particularly relevant when we look at a restricted currency?
That's a good question. NDFs have gained prominence in LATAM for several reasons. So first, they provide flexibility by allowing business to hedge against currency appreciation or depreciation. Of course, is the main reason. Okay. Second, NDFs can be cheaper than option strategies or even forward contracts as well. Okay. I mean, just from the transaction cost perspective and not the interest rate differential. This is another thing. Also, NDFs contracts they are off-the-shelf products in many financial institutions in the region. In other words, companies can find them in almost all banks across the country. Banks are very used to offer NDFs to their clients because they can find NDFs has a huge liquidity in those countries when you compare with forwards. Also, NDFs you can go far regarding the tenor of these contracts. You can place 6 months, 12 months tenor. When you compare with forwards, most of the time you are not able. The banks cap your tenor to 30 days, 60 days maximum. Because as you said, NDF you need to pay just the difference. While the forward you need to do the whole amount, which means it's more riskier from the counterpart perspective. So because that NDF is more popular, more traditional product in such countries.
So it's cheaper, it's easier to deliver, it's less risky for the bank. I'm going to put you a bit on the spot here, Matheus, no pun intended, but why would all the companies not use NDFs all around the world? Why is Forward even existing then?
This is a good question. When we look at the developed markets, Europe in general, along with the UK, US, Canada, they tend to use forwards harder than NDFs. I think pretty much because the risk of these contracts. I think the counterparts see that these developed markets less risk to offer forwards harder than NDFs. This is one thing. And another thing is because just the difference. So that allow you to I think it's the same. This is a good question. I need to investigate this a bit better. But if you go to Africa, all emerging markets, you see the NDF being used much more than forwards. In Brazil, you can use the forwards, but as I said, it's just for short-term hedging, and NDF for long-term hedges. And each one we compare the pricing. There's a large difference in pricing for those instruments.
Okay, and I see, so looking on the internet of all things at the same time, it seems that NDFs can also be, the NDF markets are also focusing on certain currencies. So maybe that's a product that is developed by certain financial institutions only in particular countries. The ones I see here are Chinese yuan, so typically a restricted currency, Indian rupee, South Korea won, New Taiwan dollar, Brazilian real, Russian ruble. So that's maybe why as well. Actually, the NDF product in itself is made more available for those currencies. Maybe Forward is more profitable for financial institutions than NDFs. But anyways, a good follow-up question, definitely. Thanks a lot for this, Matheus. So are there specific countries or scenarios where NDFs are more advantageous
in Latin America in particular? I think we've built up to this point, so the answer is quite obvious, but can you enlighten us on that? In Latin America specifically, are there countries where NDFs are more advantageous, if not mandatory?
No, I would say there isn't an all-fits answer here because the most adequate instrument will depend on the market conditions, as I mentioned before. And so if you use, for instance, Mexico, Colombia, Chile, and Brazil, all these countries, you are able to put together your hedging strategy using NDFs, okay? But that doesn't mean that NDF you be the most adequate one. You depend a lot different components. As I said, the risk tolerance of the business and the hedging cost. I would say the hedging cost is the most important component that you need to understand when you are building a hedging strategy. So NDFs can work very well in a specific market condition, while options can work very well in another specific condition of the market and different risk tolerance. Okay? So I think the business, they need to understand these components and try to identify what is the best instrument to them. How they will approach the currency risk and the strategy they'll be using, you depend a lot of their budget, their risk tolerance, and so on. So I will not say that NDF is the best one in Mexico or the best one in Brazil. No, depends on the market conditions and the profile of the business. And at the end of the day, what do they want to protect? How much they want to protect it? I think this is the idea.
You mentioned a couple cons about NDFs earlier, but there's any others that you didn't list? Any other reasons why you wouldn't use NDFs, even in LATAM?
No, I think
And you would use a forward, for example?
Yeah, usually we are seeing clients using forwards for short-term hedgings. Okay, 30 days or 20 days, maximum 60 days. They are using for tenors higher than this, 6 months or 12 months or 1 year and a half. They tend to use NDF or option strategies. See, in terms of flexibility.
And are NDFs not good? Are NDFs not good for short term, or forwards?
Yeah, it's a good question. Businesses tend to use forwards because it's easier to set up this instrument with the counterpart. Okay, because sometimes for an NDF, the business must to set a ISDA and also a credit support annex with the counterparts. Okay, for forwards, most of the time they don't need to do this paperwork. They have a relationship with the bank. I want to book a forward, and just book a forward. Just call to the FX desk and book a forward. They don't need to do any paperwork, authorizations, etc. So it's much convenient from this perspective. Okay, so because that most of the time.
Cool. So moving beyond NDFs then, what other hedging instruments are popular in LATAM? So you mentioned forwards and options. What are the other, so forwards for short term, options as an alternative to NDFs? What other hedging instruments are popular? And you broke down there, right? You would use a forward for more short term contracts, NDF for longer term. Could you also give why you would use specific ones in the region?
No, for sure. No, a part of the NDFs, you have forwards, you have options, cross-currency swap, you are enable you to hedge also the interest rate differentials, and swaps, vanilla swaps. You have these 4 or 5 instruments. Again, each one provides different flexibility. Each one can be tailored to specific risk profiles. I think that the most of them. And we need to analyze. I think that a very solid hedging problem depends on what is the benchmark of the company, what do they want to protect. I want to only protect my revenue. I want to maximize this. So it depends on the answer of the company. We can hedge just with an NDF or a vanilla option or some more sophisticated options strategies, or if I have a long-term debt with different interest payments, principal, I may use a cross-currency swap instead of place NDFs. If I'm in a negotiation, for example, let's say in the M&A situations, I have a specific deal. Maybe it's a local company selling some stakes for other offshore company or other business abroad, but I'm not fully certain if the deal will go through. Okay, I know there's a FX risk because I'm pricing my company in local currency, but the buyer potentially you buy the company using dollars or euros, so there's a currency risk in the transaction. No? But for example, I'm not completely certain if the deal goes through. If I hedge this exposure using an NDF, I'm assuming that the deal will go through. So I will have obligation at the maturity. Okay. So what will happen if the deal doesn't go through and the position will be negative? I will have a loss and I will not have the deal. Okay, so the company will find itself in a big trouble. So the idea is to understand which derivative will be the best one for this specific situation. It's better just to buy a vanilla or option vanilla. So I have the right to protect against currency risk, but I don't have the obligation. So it's completely different story. Okay, so in this way, it can be protected and not have any collateral damage if the deal doesn't go through. Or I can use a deal contingency hedging, which is another type of structure. It's a structured product. Inside of it, this contingency hedging, you have a plate of forwards and options inside of this product. With the particular goal, if the deal doesn't go through, I don't have any obligation. If the deal goes through, I'm protected. Okay, of course, each one of the derivatives have their own cost. We need to understand this as well.
Makes a lot of sense, Matheus. I think you've touched upon it a bit earlier in this interview, but can you maybe break down for us how is the Aglo approaching the FX risk management space, in particular in LATAM, and with the various solutions available, what makes the Aglo approach particularly suited for LATAM?
Certainly. The Aglo takes a holistic approach to FX risk management in LATAM. We provide a customized solution tailored to the unique challenges of the region, combining technology, for instance, machine learning, AI, Bayesian regressions, and very statistical approach, and with our local expertise. Right now, we are building a very strong team in Brazil, okay, in order to be closer to our clients and potential clients. Our goal is to empower a business with the tools and knowledge they need to navigate in this dynamic FX landscape successfully. This is the main goal. For instance, throughout our FX risk management platform, our clients can gain access to market data, trends, analysis to make a more FX decision. They can use Monte Carlo simulation to model potential outcomes, incorporating different inputs such as volatility, skewness, amount, maturity to calculate potential loss, which is the volatility risk. They can develop tailored FX hedging strategies and compare the performance of each strategy, considering factors such as hedging cost and their impact on exposure. From the liquidity perspective, the collateral perspective, we can the tools are able to evaluate the various hedging instruments, as mentioned here, NDFs, different option structures, cross-currency swaps, and so on, from the liquidity perspective, analyzing their collateral implications. So for those companies that it has lower liquidity in their cash flow, they need to understand the liquidity implications of such instruments. When we deploy our tools for the industry investment, let's say fund manager, institutional investors, we have created a tool that is able to compare different cash flows in terms of a cash flow with hedging and another cash flow without hedging, but looking from the IR perspective, looking from the performance of the cash flow. So we can assess the impact of the currency hedging on the fund's model's performance and compare cash flows with and without hedging. So what we are creating is a number of statistical tools that will provide more statistical insights, more data for our clients to take more informed decisions.
Yeah. Matheus, tell us the difference between the costs of hedging in LATAM versus other regions. Is it because of this complexity, and the main takeaway I have from this whole episode is the complexity in LATAM versus other regions? Because you just have so many different economies that are doing very differently with different currencies on top of that. And on top of that, some of them are restricted and all have very different currency policies as well. Is the cost of hedging higher in LATAM versus other regions? And if so, how do businesses manage that? How do you go about managing that and reducing?
Certainly, that's a very interesting question. The hedging costs in LATAM is influenced significantly by the interest rate differential, as I mentioned in the beginning. So making them relatively higher compared to regions with lower interest rates. Okay, when LATAM countries have higher domestic interest rates than those in major currencies like the US dollar or the euro, it can increase the cost of the hedging. Okay, so it's just so let's consider Brazil again as example. In recent years, Brazil has experienced relatively high domestic interest rates due to its efforts to combat inflation. Pretty much after the COVID pandemic. So by 2021, the hedging cost to hedge the BRL back to dollar was 8.4%. In 2022, it was 6.7%. And currently, the hedging cost is around 3.9% per year. Okay, why is reducing? Because for too many reasons. First, the Brazil Central Bank is cutting their interest rate, the Selic rates, recently. And second, the Federal Reserve is doing the opposite movement. They're hiking their interest rates. Okay? So the hedging costs are reducing because the difference is reducing between the interest rates. And you can use the same knowledge for Colombian peso. The Colombian Central Bank is also hiking their rates to curb inflation. Mexican peso, the same thing. Chilean peso, the same thing. I think overall, the overall economic situation in the globe is the same. But when you compare the hedging cost between euro and dollar, you see you not hit 80% as we saw in the BRL. This will be much lower, okay? Because the interest rates in both countries are much lower, okay? So when you have a higher interest rate in one country and lower interest rate in another country, you have higher hedging costs. I prefer another terminology to refer to hedging costs. I like to say hedging impact and not hedging cost. And why hedging impact? Because the cost will depend on the direction of the trade. Okay, if you are buying dollars and selling local currency, Mexican peso, Brazilian real, and so on, okay, that's a cost. You are against the curve. But so if you need to protect some liability in dollar, okay, you are against the curve. But if you're exporter, your revenue is in dollar, you need to hedge selling dollars and buying local currency. So you are the opposite way of the curve. So this is not a cost anymore. This interest rate differential is a positive carry. You have a pickup in your hedge, so you are able to maximize your revenue because you'll be converting much more, let's say, Brazil real with the same amount of dollars. Okay, so I like to say it's a hedge impact, this interest rate differential, rather than a hedging cost, because it depends on the direction of the trade and direction of the protection.
And what can businesses do to minimize their hedging impact if they have to operate in between two regions that have a high interest rate differential? Are there any strategies businesses can implement?
Yeah, first we need to understand the duration of your hedging. We need to understand if there are window through this interest rate differential curve that provides opportunities to hedge with a lower cost. So it's not because I have a 12 months maturity that I need to hedge straight 12 months. Maybe I can hedge 3 months and then roll it to additional 3 months and so on. Maybe doing this is cheaper than to hedge straight 12 months. Okay, this is one of the things that you can do to reduce the hedging cost. Other thing is to work with the hedge ratio. Okay, so the first question that we need to ask to those who want to hedge is what portion of your cash flow or your portfolio you want to hedge, you want to protect. You want to be fully hedged, means zero currency risk, or your risk profile will allow you to have some downside risk, but at the same time you have some upside participation. Okay, depends on the hedge ratio. So if you hedge 100% of your exposure, you have a higher hedging cost when you hedge 50% or 75%. Okay, that's another element that business can work with. What is the hedge ratio that will reduce my currency risk, but at the same time will allow me to manage the hedging cost. And the third one, I would say, work with options. Option strategies, as I mentioned in the beginning, is 3 components of the pricing: interest rate differential, volatility, and time to decay. Okay? Because they have 3 components, we are able to work with the options, analyzing the market conditions. So the volatility reduce, okay, I may have a cheaper hedging because the volatility reduce. Or even though I have a high interest rate differential, the short term of the option might be cheaper than I place NDF, for example. So each case is a particular case. You cannot as I said in the beginning, we don't have all-win answer for all situations. So we need to understand the market conditions, the risk profile, what the client wants to hedge in order to reduce the hedging cost. Unfortunately, there isn't a free lunch, so we need to be very flexible, be very creative, work with these market conditions to take advantage of these components, and of course understand these tools. We need to understand these hedging contracts to be able to deploy the best hedging possible.
Matheus, thank you so much for that. That's quite an episode on LATAM, and we see much clearer about foreign exchange risk management over there. Is there anything you'd like to add in regards of the different topics we tackled that we didn't have the chance to touch upon maybe?
No, I think it was a very extensive conversation. We covered the hedging costs, the different hedging strategies, the volatility of these currencies in those markets. What triggered this volatility? We discussed the inflation, we discussed the actuation of the central banks and also the role of the governments to tackle the currency value against the dollar, against other currencies. So I think we covered most of the elements and most of the hot topics in LATAM one regarding hedging.
100%. And thanks a lot for that. Very cool. If people would like to know more about you specifically, your operation in Latin America or Diaglo, where should they go?
No, yeah, for more information on Diaglo and how we can help, how our comprehensive solutions for emerging markets, in particular for LATAM, I invite everybody that is listening to us to visit our website. It's diaglo.com. So there you'll be able to see our solutions, who we are, our team, how to get in contact with one of your FX specialists. You can send an email to us. It's Diaglo. It's info@diaglo.com. You can send an email straight to us.
Amazing. We'll put all the links in the description and also add your personal LinkedIn profile if that's fun for you so people can find you easily. Matheus, thank you so much.
Thank you. It was a pleasure to share a little bit of my experience, and hopefully that will be very useful for everybody that is listening to us.